Hello, welcome back. In this video we are taking a look at DraftKings. It is a stock that is currently trending. You'll see that a lot of people are actually taking a look at this one, and it makes a ton of sense. If you take a look at the max chart over here, you will see that obviously this was a SPAC, so it started near $10 pretty much, but it has been climbing a ton. Like at some point it was over here, you can see it was like 67, pretty much near 70, and then it started going down and down and down. Now, what is DraftKings? So DraftKings was basically a private company that was merged with this SPAC. So basically a SPAC was formulated, and DraftKings became the merger pretty much. Actually, when the merger completed, DraftKings is now the SPAC entity. So what is DraftKings? In case you are not aware, you can always use our company profile page here in our tool, in which case you see that this is basically a gambling company. It operates as a digital sports entertainment and gaming company, multi-channel sports betting and gaming technologies, powering sports and gaming entertainment for operators in 17 countries. And you will see that it also offers curated NFTs and things of that sort. So a lot of virtual stuff going on there, and of course it kind of took a hit when pretty much the whole NFT market and crypto market has been crashing for the past more than a year, pretty much or so. And so again, this has been dropping quite significantly, and maybe it's a good opportunity. This is what we're going to be examining in this tool, as it's actually about 50% down from its 1 year high and much more from its pretty much all-time high, as you'll see here. Okay, so what is up with this company and what about its financials? You will see that the PE ratio is actually still negative, so the company is not really making profit, and this is a big problem here. It's spelling some trouble for potential stockholders. And the price to free cash flow is also in negative territory, similar, pretty much a similar graph over here. And also, what is even worse, what adds more salt to the wound, pretty much, is the fact that the outstanding shares of the company are still climbing a ton. The company needs to fund themselves, and the way to do that is by issuing more stock. Is very problematic because obviously you are getting diluted if you're buying the stock. If you bought the stock, for instance, here or here, you have been getting diluted for a while now. And also, the total liabilities to free cash flow is a negative number here because the company doesn't really generate free cash flow. It's a negative, and that's a big problem because as the company is not making money, they have two ways to fund themselves. So one way is to still issue more shares, so keep issuing shares and diluting you, which is bad, obviously very bad. And the other thing is get more debt, which is also bad if they overdo it. Now, they haven't overdone it, it looks like, yet. Like the debt to equity ratio is not that high, it's not more than 1, for example, but it's increasing. And you can understand that it is increasing for a reason. Again, because the company is not making profit, and this is problematic for a stockholder, as you can tell. Now, the revenue, and this is the good thing, the revenue of the company has been climbing a lot. And so this is a nice thing here. So this gives you a little bit of a leeway here. What about the income, the net income growth, though? This is going down, and the free cash flow, again, you'll see they're very similar charts here, pretty much following each other. And the total equity growth has been going up, but not because of profit, as you'll see here, but because of outstanding shares. This is what's happening. It's basically the company printing more shares and getting money from new shareholders and or old ones that are actually buying more, and pretty much funding their equity through that. This is the story of the company, and this is why this kind of handy little metrics here can tell you the story instantly without even having to look at the financial statements, which we'll do anyway because we at times discover other important things about the company. And again, the margins here are negative, the company is losing money, and the returns are negative too. We always take a look at the financial statements because we kind of want to see the trajectory that the company has been following, like $200 million in terms of revenue and 1.3 in terms of revenue in 2021, the fiscal year, which is great. The company's revenue has been increasing, and this is a nice thing to see. And you can kind of take a look at the quarterly as well, also showing signs of increases, for example, in Q3 2022 here. Let's go back to the annual. Now, you will see that the net income of the company is negative, and the problem is that it's getting even more negative. And again, losing just a little bit, losing more and more. This is not what you like to see. This is pointing to a company that is having a lot of trouble producing producing net income and profit, pretty much, and they are operating on a trajectory that should be the opposite, pretty much. So this number should be here, and this number should be here. Then we're talking. But now this looks like it's getting into more negative territory here, more and more negative. So it's very, very problematic here for the company. Now the balance sheet, as you'll see, it's up, like the total equity is up. If you see here, you'll notice that it is actually negative over here. The total equity is negative. And so what happened is additional paid-in capital, as you'll see over here, 4.4 billion, 5.4 billion. Basically, the company issued shares, what I told you earlier. The company issued more shares, and this is how they were able to fund themselves and basically increase their total equity. That's the story, pretty much. It's not about the profit that the company generates, because it doesn't. And again, the net income here, you can kind of see it laid out over here. And basically, after the adjustments for stock-based compensation, which is a lot, this is what a lot of these companies do. Take a look at this trajectory from 4 million to 683 million. That's basically how they're paying their employees through stock, it looks like. And basically taking it to operating cash flow that is still negative and getting more and more negative. Very, very bad signs here for the company. Everything is in the minus. And in terms of the free cash flow, again, the same thing after accounting for capital expenditures, which are likely not that high as you would expect for this kind of like online company. The free cash flow is still in negative territory, and very, very negative territory. So it makes a ton of sense that the company has been going down. It doesn't look like it's going to be doing well anytime soon. Now, at times when we're looking at a company of this sort, we could always take a look at our metrics tab and, for instance, evaluate the price to sales ratio. So be like, okay, is this low enough? Maybe it's a potentially interesting opportunity here to get a huge amount of revenue for a low price, for a low stock price. And it has been getting better, that's for sure. You can kind of see here that the tool becomes a green if the ratio is less than 2, pretty much. While anything below 1 is excellent, as you can see in this very handy little tooltip. But when you are using these kinds of metrics like the price to sales ratio or the EV to EBITDA ratio, it's already problematic because you are betting on companies that are not making money. So you have to take it with a grain of salt and be willing to take risks, is the thing. Our financial statements here, if you go back in our income statement, for example, will show you the EBITDA of the company, which is basically the earnings before interest, taxes, depreciation, and amortization. What this means is that it basically excludes expenses. It excludes all these 4 types of expenses like interest, taxes, depreciation, amortization. And so you kind of want this number to be as positive as possible. And it's still negative. It's still under negative territory, and quite a lot of it, actually, 1.3 billion, while the net income is minus 1.5 billion. So not much of an adjustment here. The company is losing a ton just from its operations, pretty much. But what about a potential buy? What could be an interesting case here, even if this company is super risky and even if it has it's problematic? Maybe it's worth a buy for somebody who is willing to take the risk and maybe hold it for a while, acknowledging that this could go wrong. But what is that price to pay today? So in this case, we're going to be taking a look at our tool, of course, our discounted cash flow model tool, which you can have access, all our Patreons do, by becoming a Patreon, or you can find a link in the description box below this video if you're interested. You can have access to everything that I have used so far, and more, much more. And you will see here that the revenue growth of the company has been stellar, like 50%, 80%, the 3-year average. So it's pretty stellar. You will see here. Of course, it has been affected by the past couple of years quite a lot, but still, it's very, very high. And so now, what are we going to be doing here in terms of the revenue growth that we're going to use? We will deliberately use high values because we assume that this kind of company will be growing at a tremendous pace. Otherwise, it doesn't make any sense for us to be buying this one if it doesn't grow a lot, because again, it's losing money. So we have to kind of assume that the company is going to be growing at a nice pace, at a very nice pace, overly nice to be sincere. But the problem is the net income margins are very negative, so the company is losing money. We cannot operate under this assumption forever. If a company keeps losing money, then it's not worth anything. It's actually going to go bankrupt eventually. So we have to operate under the premise that the company will reverse course and basically start making money. This means that their net income margin will start getting into positive territory, something near 1%, 3%, 5%. So let's use these values, 1, 3, and 5, which is like marginal profitability. What happens if the company becomes marginally profitable is what we're saying here. And the free cash flow margins that we're going to use, again, we cannot really use the past because it's been negative all over. But we're going to use something that is rather typical, about 80% of the net income margin being our free cash flow margin, 90% and 100% here. And the annual return that I'm going to be using is 13%. Now for this one, you may want to ask for even more, maybe even 15, 60%, because it's very risky. It's a risky proposition here to be buying this company, as you can understand. So again, if you have access to the tool, you can try all sorts of different valuations here and all sorts of different projections whenever you like. If I hit calculate, let's see what we're getting. You will see that our current price is still extremely expensive, even after we account for a potential net income that becomes very marginally profitable here. And we're nowhere near that, right? I mean, remember, the net income margins are very negative still. And so even if we get a 5% net income margin with a 35% revenue growth and 100% in terms of the free cash flow margin, which is like 5% pretty much, it's 100% of the net income margin, then we should still be buying this one near $7, and the current price is double that. So it's very, very expensive for what it is, even if we account for the company pretty much being profitable. And this is why this one is extremely risky here. It doesn't make a ton of sense to be holding this one unless you are potentially looking to trade, just because, this has been going up and down a lot. Maybe, there is some sort of a reversal in the sentiment. And so maybe this starts going up because it's traded basically as a company, as a stock basically, that is having a positive sentiment. This is pretty much the only reason why this could go up for a while now, because the actual operations are pretty terrible, and I would be very, very careful about owning this one for a long term. I definitely wouldn't, frankly. But again, for trading, different story. Trading works in a much, much different manner. For a long-term investor, though, super risky. Probably I would avoid for a long time now, unless it goes maybe to $5 or something of that sort. But thank you for watching. Do tell me what you think about DraftKings, whether you own it, at what price did you buy, or what price you could potentially expect it to buy it at. Maybe it goes down to $5, $7. Would you pull the trigger then? Leave a comment below. I'm curious to see what you think about DraftKings. It's an interesting case, at least, to study. And thank you for watching this video. Stay tuned, there's gonna be more. If you are new here, remember to subscribe, and of course, if you enjoyed this video, please leave a like, that helps a ton, and I'll see you soon. Bye-bye.